Good morning, everybody. It's good to be with you. As you can probably recognize, I'm not Kevin. Um, Keith Bybee with you today. Kevin had a meeting he had to couldn't reschedule, so I'm taking over again today, and that will be good because it gives me a chance to kind of follow up a little bit on some of the things we talked about Tuesday night. Um, So let me just get right into it. Couple things that I thought was interesting. I had this article up by Kramer. I'll let you go and watch that when you have time. But basically, he's saying kind of the same thing that I was saying Tuesday, which is my market thoughts, and everything's kind of going up, and we've got mixed earnings, mostly awful, economic numbers awful. He further makes the point that we when we get to Friday's employment report from the Labor Department, is it going to be so bad that we're going to be debating whether we're in a serious recession or a depression? Another quote down here: if you make technology, just make sure I've got my screen sharing. Yes, I made that mistake last time. Didn't share my screen. I said if you make technology that helps businesses cut costs, especially by firing people, you're doing fine. If you make something that people literally can't live without, like medicine, you're in good shape. But just about everything else is struggling here, hence the staggering number of layoffs. So, why the heck is the market still going up? If I can get on my soapbox a little bit here, so much of what's happening doesn't make a lick of sense. We've got the NASDAQ that is now positive for the year. Let me update this. And that is the more technology companies, so I I get it. But positive for the year with the most jobs lost and in the shortest amount of time I think ever. Um, all right. So, I mean, Kevin and I have been back and forth, and we've struggled with this. The April rally, we've struggled with understanding the whole thing. On one hand, you have $2 trillion coming into the system, the economy, um, that is helping more of the big businesses, not necessarily the little guys. Everyone I've talked to that owns a small business is scrambling trying to get cash from their banks, for small business loans and the PPP and everything like that. It just it's not getting to those people very quickly. And we sit there and talk, and I hear Kevin talk about, you know, he's up at in the middle of the night to see the Asia markets coming open, and up again to see, Europe come online, and how little sleep either of us have gotten for this last quarter. um, it's kind of frustrating, and on one hand, we can't complain that things have come back so much because that's helped us out too. But to look at everything and see what's happened and see all these negatives, it's very hard to understand what just seems like a lot of greed that's pushing up our markets. And that part of it has been very frustrating because there's really not a trend that you can really trust right now and really understand. Well, I'm kind of at a loss for words, but we're set up, let me just tell you, we're set up to still have some protection on right now through with our stock positions and running bear puts so that we can still make up money on the way up and not be too killed by volatility crush on our protection. And we've gotten, as earnings have happened and companies like Disney have not fallen with their report, we've looked and been patient with adding short puts to pay for our long puts, but to have some portion of protection. And really it is, as Kramer mentioned, we're looking this week towards Friday, and if we don't get somewhat of a sell-off from more jobs being lost, higher unemployment numbers, and just kind of keeping that in the back of our minds as we create a little bit of credit to pay off our long puts for protection through earnings as things come back up a little bit without, how should I say, I guess going full bore bullish, especially after we've seen an April record month, bull month, with everything coming back as much as it has. And that's kind of what's in our minds and our thoughts. But what kind of questions do you guys have? What kind of yeah, I guess I'm just going to give you what questions do you guys have today? Feel free to pipe in whenever you feel like. I'm going to follow up here a little bit on what I talked about Tuesday. We talked a little bit about Disney. I kind of just mentioned, but we have protection there. I did get a question in. Let me get to that in just a sec. We do have protection on Disney that's still kind of at a break even a little bit as Disney's come back up a little. A little open Disney. Hitting a pivot point is above the 50-day. So that was one a little later today, we're looking at possibly having a short put with a strike down at maybe 95 to help pay off a little bit of our 105 puts. That's what that is. Just to have a little protection if things come back down Friday. And anything bullish that we talked about or anything that you put on today, you're just going to have to be okay with a possibility of a down day tomorrow. So let me get to some of these questions. Rich asked, where does FinViz get its numbers from? That's a good question, Rich. I'm not sure. I'm sure they source it from everywhere that has the information. They probably draw much of it directly from earnings reports from individual companies. I would assume. I assume most sites that show fundamental numbers have gotten it from the actual businesses. You also have the analysts' projections and all that, and I just assume they put all those things together themselves. Another question: have you found any strategy like bull calls, bull puts that work in this market environment? Well, I assume, Ida, you're asking option strategies because we talk frequently, if not every time, about our collar trades. That has bought us hundreds of more shares in different companies, in our Disney, in our, I showed you my Target, let's see what else. Under Armour, we've doubled shares, all paid for by protection. What else? Ford, Apple even, that didn't really have as much of a drawdown as a lot of other stuff. So yeah, that's working. But as far as spreads, yes. I like to talk about leaps because it's easy to dollar cost average. Those leaps that I have aren't necessarily working in the near term, but through a process of dollar cost averaging, have a higher likelihood of being profitable out into the future. So I guess you could say those will work. Bull calls, you could still do. My bull call, actually it was Kevin's that did the GE one, has not worked necessarily, even though it's out for a year. That's one I'm not sure how best we'll manage. We've dollar cost averaged it. Trying to decide whether to close short calls and buy more shares, or if that's just silly and we look at something else. But no, I mean, bear puts really alone have worked for some stuff, not necessarily for others. We've mostly used bear puts for having some level of protection and adding another set of bear puts if stock prices fall through the lower short put. And a lot of those have gone well for Visa, as you know, that had dropped down. We kind of were stuck with bear puts as opposed to straight long puts. But things we did for the indexes, some bear put spreads looked great when things were heading down, and kind of came off with a break even, not a little bit of a loss as things came back up. But I guess that was more for protection, not necessarily trying to trade direction. Yeah. Option spreads right now are a little difficult. I can tell you the covered call, if you'd gotten into it on target Wednesday morning, I think with these numbers, it'd have been hard to get exactly this, but you still could have gotten something close, if not gone up in a strike price, and been pretty good with that. And you could probably even close it off for a profit today if you wanted to. I'm choosing to wait a little bit and get called away for profit on target. I think that will work. This Facebook leap, if you'd gotten into that. Let's look at Facebook. And the Facebook leaps that I've had on for me and my clients, Ida, have done phenomenal. So this is one that has been awesome. So I would assume we would get some struggle up here at around 219, 218 on Facebook. But if you're looking now, if you haven't already gotten in on Facebook Leap, you look at it tomorrow, see if it doesn't pull back a little bit on a Friday, and with those jobs numbers I previously talked about. But I see no reason why you can't have a bunch of time there for that to go out. Bull call, you could think about it, but you know, as volatile as things have been, and at really any moment, any news that the market doesn't like, your bull call falls, and you do have that short call to protect you, but you might just not have the time for it to come back. So that's why I'm leaning more towards that. I know we have high volatility, and you could find a way to profit from volatility crush, but you know, you're just more often than not, you're just taking more risk than need be, and really that's our covered call strategy here with target is gonna be profitable with the, you know, volatility crush, without being so risky, like as much of a short put down far out of the money. I know some of you had mentioned some success with that. Some of you had mentioned success with the calendar spread. You know, if you even want to try that with a Facebook, go out in time and do a calendar spread on a leap call with Facebook. You could go at the same leap and go up to see what you couldn't get for like 260 or something. Let's see. And let's see. Go. We already have Facebook open anyway. So this is where we have leaps over here at 250. You could go up to, that's not a calendar spread. We'd have to go to, let's see. June 20 is too close, but let me see where. Yeah, you're not getting anything. September. Not really getting enough to justify it. Good, January 21. Yeah, I don't see that as useful. Only getting $5. The problem is you have so much you're paying in premium out to January 22 that it doesn't really justify being capped there. You have the time. So if we went and looked at maybe September. September 220 maybe. And let's look at June. $230s, you get $2. So you'd spend $11.30 to make 10. So do you kind of see with that why that doesn't work? Obviously, you'd want to make more than what you're spending. So we'd have to go closer. Let's look at, get rid of this one. Let's just look at June. Do a June 220. June 5th. So spend $292 to make a possible $5. So you'd be making $2. Doesn't seem worth it there, but I guess the point is you have a June 5th that would expire worthless. That would be the main thing to go for there, but that could, who knows, Facebook could go well above that. So the strategy, I guess, for a calendar would just be to do the similar thing that a covered call would be, and have the chance to roll this June 5th, or have it close under 225 worthless and roll another one out and up to the June monthly to have some more credit into the against your long call. But at that point, I think the risk there isn't as worth just doing a straight bull call instead of a calendar. Because if you compare it to this bull call, same month of expiration, same and looking at the same strikes as the calendar spread, you're spending $1.70 to make $5. So you have $3.40, $3.30 of potential profit as opposed to under 2 with the other one. So yeah, a long and drawn out way of looking at it. The numbers just seem to say it make more sense to do a bull call in that case. But my suggestion for something that you believe is gonna continue to do well through this period and keep going up is like something like Facebook would just be to do a leap. And I know you guys maybe want to hear some more creative stuff and but this is what I'm seeing works. So that's what I'm going to suggest. By chance, did anyone get filled at a close price to what I suggested on a target covered call? I assume not. Let's just look at it again. Up at 114. So I would again wait for it. You can maybe look and see if it comes back down to those same prices we talked about, 112 or even a little better. Seeing if it comes back tomorrow. And then that would give you the chance to be in that. And again, it was a 112 price for a 112 strike May monthly short call. I would think you'd get pretty close to the same credit if it comes back to those levels. But whatever you would get is what you would get. $2, anything over $2 would probably be worth it. Let me look at, I know I mentioned AOBC a little while ago. They're struggling to get over 950. They did bounce off of this pivot point right on 888 today. Got close to it a few days ago. Again, with gun sales, outdoor equipment, I still feel like this is something worth looking at least between trying to play off of these pivot points. And it's down today, so So what if we did look at something like this? 950, 10, spend 15 cents to make 50. That might not be bad. I would probably look at this tomorrow though, because of all of the same reasons I've mentioned. Seeing if it tests that pivot point again, and you could even get in at a lower strike price, the next low strike price down 9 into a 9,950. That is a shorter amount of time. I'm always going to look more for more time. So go to the monthlies. The monthlies kind of forces us into a 9 and 10 strike. So spend 42 cents to make $1. That's not too bad. What if we went out even a little further where we could get different strike options? 950. Well, so this is funny. You have these huge bid and asks. You would have to put it way down here, maybe for 15, 20 cents or something like that to make. I would go even lower than that. I'd go 15 or below, just to see if you don't get filled, just because there's such a spread in between there. You don't know what the broker is going to fill you at, and obviously you don't want to spend 50 cents to make 50 cents. I don't think that is worth it. Maybe you go even 20 cents. I guess that's something you'd have to play with. 15 cents, don't get filled, move it up to 20, 25. I wouldn't go much more than that. I don't see the benefit there. All right, guys, I've kind of talked a bit here, tried to give you some thoughts. Hopefully I've given you some things that are useful to think through, and you kind of see now why I've reverted more towards a covered call option or a leap. I just like the more time in this current situation we're in. Everybody loves to talk about credit and credit spreads, and I just, as much as we could profit from some volatility crush, we've kind of had most of that. I would think. I think if you haven't done some sort of credit spread to profit from volatility crush, you missed somewhat your chance. So I would maybe look at doing that if VIX gets back up to 50 or something like that. Then start to do your math and look at it, and I'll keep that in the back of my mind. But man, I see too many people get hosed on credit spreads too often. So you got to be really picky. And one we haven't talked about is just a regular bear put. That's tough too, because of volatility crush, that did not work very well for me for the index, the SPY, the QQQ looked amazing for a few days. These days, and looked awful for these days. And to go down and come back up and um, have some bear puts be profitable and take off of those for some profit, and then have the ones we rolled down or left on come back to basically put us net break even was kind of lame. So those are my thoughts, guys. Is there any other questions? Anything else you'd like me to look at or go over? Not, guys. That was a good chance for me to go over some of the stuff we talked about Tuesday, and I appreciate the comments, thoughts, and questions. Always good to be with you. I will look forward to hearing what Kevin has to say Monday, and I'll of course join with you. But be safe, pick your battles, and I wish you good luck with some of these trades. Take care, have a good weekend, and we'll see you next time.